Good morning. We're live with Kashop today. We've been doing these on Fridays. Sorry we missed last Friday. I was in the middle of a trip back now. We've had some good videos this week. We did the commodity report. That's every single week on Mondays with Kevin Green, and then on Fridays with Kashop. And so what we're kind of talking about here today is just the global macro market. I think so many people get kind of stuck in the stock pickers market and only looking at so many stocks, but there's a whole world out there. There's commodities, there's currencies, there's crypto, there's bonds, there's equities. And the world's a big place. So there's all of these things in all these different countries that are actually priced in different ways too. So speaking of, if you're looking at commodities in Europe, they could be a different price than commodities in the United States. Equities in different countries, Turkey obviously being an interesting one lately, having such a big move. China as well. And so we're kind of just looking at the global macro landscape today. And Kashop also had a pretty cool report on the yen today. I'll share that in a retweet for this. But basically, why does this week's move in the yen matter so much? Can you explain why, Kashop?
Hey Jason, hey everyone. The so what's happening is that for quite a while there has been speculative pressure on the yen. So we have all read the big macro stories, right? The Soros trade of shorting the pound and making so much money by going against the central bank, bringing them to their knees. All the bond vigilantes of the 80s. I don't know if anyone remembers them, but it used to be a thing where when a country does something that the bond market doesn't agree with, they would throw a kind of a tantrum wherein they would sell bonds, spike yields, and the country would have to reverse their policies. And you heard all these stories, and traders have grown up hearing about these hero trades. So, what's happened here is that the yen has been depreciating, and because it has been depreciating, everyone has got onto the trade of shorting the yen and buying the dollar. And the BOJ just let it happen. So when the yen hit 152 to the dollar, they let it go. Then it hit 155 and they let it go. And everyone thought 155 is the level at which they would for sure intervene. And they didn't. So the attack continued, accelerated, and finally, when it hit 160, they acted. And they acted pretty swiftly, taking it down from 160 to 152 in the matter of a couple of days. And they are still acting against the speculators by intervening in the currency market. Now, a central bank doesn't intervene in the currency market that lightly, especially because the US Treasury, every year, they publish a report where they call out certain countries for currency manipulation. And an act like this will make them be labeled as currency manipulators, which is not good because then you have Sauron's eye on you, right? So countries don't want to do that. And Japan, of course, is a strategic partner to the United States, so they don't want to do that. So the hypothesis here is that the BOJ is intervening in the currency market with the full blessing of the Treasury. So if you look at the timeline of how it happened, so there are three things that have happened this week. One is that the offshore Chinese yuan has strengthened against the dollar. The other is that the Korean won and the Singapore dollar have also strengthened against the dollar. And of course, you have this big move in the yen. And coincidentally, this all started right after Yellen's visit to Asia. So, why is this relevant? So, here's the thing with currencies. So, currencies, FX rates, interest rates, bond markets, these are all intertwined. And because we are in a pretty global market, Japan and US are intertwined. Japan and China are intertwined. China and US are intertwined. So, all these economies are connected and they are connected by the capital flows. So, when you have an outsized move in a currency, it's going to impact everyone. Now, China and Japan are the two biggest foreign holders of US treasuries. Now, when their currency is under pressure and the central bankers want to stop the depreciation in the currency, what do? They have just one tool. So, sure, you can impose capital controls, which is what India did. but China already has capital controls. So when China wants to control the FX rate, what do? They have to sell bonds. So they have to sell bonds and use the dollars to buy back their currency. So that way they put a bid on their currency and offer on dollars. So they take the speculative pressure off. And it's the same case with Japan. So if Japan wants to intervene in the currency market, so it's USD slash JPY. So which means if they are buying JPY, they are selling USD. And that means that they need to sell bonds to get those dollars. But the thing is, if they sell bonds, that's going to increase yields for the US. And right now, we already have the Fed, which is doing QT, and you had the Treasury recently came out with their quarterly refunding announcement where they said they need to raise like $200 billion or something more than expected, something like that, like not exact numbers, but that spooked the market. So now, if you have the BOJ selling bonds or the PBOC selling bonds at the same time the Fed is doing QT and the Treasury is trying to raise money, the dynamics just don't work. So the bond market will crack. So likely what's happened is that the Treasury has green lighted the currency intervention in order to make sure that foreign central banks don't sell treasuries at this time. And so for me, the way the trade worked was first I was looking for the Bank of Japan to interfere with the yen depreciation, and they didn't. So I had a long yen position which got stopped out, but I just kept watching this happen. And the moment I saw them intervene in the market, it all just clicked together, and I realized I have to buy bonds. So that's how that came about. So this is the whole chain of logic, and of course there were other reasons to. So so if you look at someone who's buying, say, Bitcoin or a stock, what do they say? They're like, I'm buying the stock because the PE is cheap. And that's one single data point, and that's all they do. And macro doesn't work like that. You can't just use one single data point and take a trade, because if you do that, chances are you're going to be wrong, especially if you are employing first order thinking, you're definitely going to be wrong. So what I did was I looked at where the positioning was in bonds. So I looked at the COT reports. Leveraged funds are net short, and not just net short, they are record net short. The positioning is skewed. There is almost no volatility in the bond futures. And when you look at this and you look at what's happening with the yen and you look at what's happening with the Treasury QRA announcement, and you look at their buyback program, and you look at the fact that you have an FOMC this week, which is expected to be dovish. And Powell explicitly came out and said that he said the next move will not be a rate hike, which means the next move will be a cut. And they also reduced the size of the QT. So you have all these factors coming together. And so I realized the trade with the yen is to buy bonds. And I'm not sure if I managed to communicate the message here, but that was the reasoning that I went through when I saw this happen. Now, it's not just the one trade. So the intervention of this sort, you also have to think through what this means in a broader context. So the reason yen has kind of been in this downward spiral is because 10 years ago, they decided to embark on a QE program. And because they had interest rates at below zero at that time, everyone borrowed in yen and started investing it in the global markets. So Japan has always been a very, very open economy, not in terms of imports, but in terms of exports and capital flows. They have always been a very open economy. So what happened was investors all over the world went to Japan, borrowed in yen, and took those loans, moved it to other currencies to buy assets in other countries. So a lot of that went into the Chinese tech bubble of 2012, 13, 14. So you had all these unicorns coming up in China, the tech unicorns, and the money flowed into that. A lot of money went into US real estate, it went into US stocks, bonds, everywhere. And so, where do you have the biggest concentration of risk? The biggest concentration of risk is all these Japanese banks which have lent out money, and that money is no longer in the country. Now, if the Bank of Japan intervenes and strengthens the yen, that is, lowers the USD JPY rate. So suddenly, all these banks are going to be in a difficult situation because they don't know if their borrowers' collateral is good or not. And the borrowers are in the same situation. So you have a situation where for the last 10 years, the currency has depreciated. So even if prudent borrowers had started to hedge their currency risk back when they started taking these loans, by now they are not hedging anymore. You put on a hedge for 10 straight years and the hedge loses money, your risk manager is going to come and tell you, take off that hedge. That's better for our returns. And that's just how it works. And so you have had a big bubble of borrowing in yen, buying assets in other currencies, denominated in other currencies. And so if the yen strengthens, this whole trade is going to unwind. So this is kind of similar to the Asian financial crisis of 1997-98. It's similar to the Russian ruble collapse of 2014. It's similar to the Sri Lanka situation of 2022, although it's a very different context. But you have every situation of this sort is because you have a currency mismatch. So, wherein you borrow in one currency, but you invest it in another country in a different currency, and then you don't hedge your risk. So, we have seen this. In fact, even you've seen this in the Eurozone, where Eastern Europeans used to take mortgages in the Swiss franc. And then, when the Swiss franc appreciated, they were deeply underwater. So you have these big macro situations and they come along very, very rarely. So when it actually bursts, it's going to have implications for pretty much every market Japanese capital has gone into over the last 10 years. Now, the biggest beneficiary of Japanese capital is used to be Chinese stocks, but no longer because China has been in a bear market for 10 years. So the current biggest beneficiary is US stocks. And of course, when it comes to US stocks, it's US tech. So SoftBank is a big player in the private equity space. It's a big player in the overall US tech space. And SoftBank recently did an IPO of their 5% stake in ARM Holdings, which values their 95% of the remaining ARM stake at more than the entire value of SoftBank. But you have these insane valuations, and SoftBank has taken so much debt, both with the company and through their funds, and all of it in yen, which has been invested everywhere in the world. So, if the yen strengthens, what happens to the balance sheet? What happens to the balance sheet of all the Japanese banks which have given out these loans? So, these are all the questions that everyone's asking right now. So, a situation of this sort just tells you that something nasty is underway. Now, obviously, if the situation is so bad, why is the yen being allowed to strengthen? That's the natural question. And the answer is that is just there is a point at which the central bank has to decide whether they want to become a emerging market or a basket case country like say Zimbabwe, or whether they just want to fight to maintain their developed world status. And I think Japan has clearly chosen the latter path. They want to maintain their developed world status. And if yen crosses 160, and now that they have intervened, if that intervention fails, all of a sudden, everyone is going to think next stop is 200, next stop is 400, and it can get to 400 because in the 1960s the yen was at 400. So why not? So now when you have this kind of an attack on the currency, and Japan imports pretty much everything. So when the population is going to start seeing inflation accelerate, and especially because it's a country of savers, it's a country of old people who are living off their life savings, it's going to have a major impact. And I guess at some point it was just politically untenable for them to just let the yen keep sliding, and they intervene. And there's another dynamic at play here where the ruling party was kind of caught doing something illegal with campaign slush funds, and that's also a negative PR campaign going on over there. So maybe I don't know exactly what went on behind the scenes, but at some point they decided they needed to intervene, and when they have to intervene, if they sell treasuries, the US is in trouble. So the US has green lighted it. So I don't know how this is going to play out, but this kind of sets the scene as to what's happening. And I hope I made sense. So yeah, I'm just going to stop here.
No, that's perfect because it's how it works, and I think that's why. I mean, it's a whole different conversation, but I think that's why you see so many traders kind of having a ADHD or some sort of like thing where they piece everything together. And that's kind of like when you're normal people when they have conversations with somebody. If you're, saying something and they're like, "Well, I also did this too," and sometimes people who are, not typical, when they're not typical people, they will think that they're actually telling you a little bit more about themselves, opening up a little bit more because they're connecting things. I'll have conversations with people and I'll say the weirdest thing and they'll be like, why did you say that? That didn't even make sense." And I'll be like, "Oh, it connects because of this." And they'll be like, "Oh, that's really weird that you made that connection." I think it's part of being a good macro trader is having that understanding that like you might be a little bit different in being able to put things together like that, but that helps you as a trader. Because really, like you said earlier, I like what you said earlier, like we can't look at anything black and white and just go, "Hey, this is perfect. This is the way it goes. This is how, trading works." You just buy a low PE and you're off to the races, or a stock that's crashing, you buy that, like it's just not that simple. I wish it was. It just isn't. So how do you do it? Well, there's many ways to do it, but it's also piecing many things together. Putting together a thesis like you do, a fundamental thesis, there's many parts to it. There's the micro part, which could be just looking at the currency, looking at the country, and then there's the macro part and how it all connects. I also like the demographic part. I don't know if any people pick that up or have studied that in Japan. Like you said, it's an aging nation. They don't really produce a ton of things. There's not a new generation coming in to start something new either. So they're having a lot of issues because of those things. And part of me thinks that they know all this stuff, which is part of the reason why they're trying to hold up their country, the stock market, the currency, the economy so hard right now because they are in that situation. I'm not a big fan of the guy at all, but there was that book. What was it? The Demographic Cliff. I don't even want to say his name because I don't want to give him any credit, but he actually did come up with a cool thesis, and I think about Japan, and it has played out pretty well. Once again, it doesn't mean that everything's going to crash tomorrow because, like Kashap said, there's many parts to this trade. There's many parts to every trade. And so, kind of now seeing all these things kind of coming together, you're saying that the yen, you want to buy bonds in Japan or globally or the United States. What are you thinking about the bond market? Because you just mentioned
Um,
bonds.
yeah, so I just bought bond futures in the US, so I'm not very familiar with how the bond market works. So
Mm,
that seemed like the easiest trade. But the idea behind buying bonds or buying treasuries is that the way it plays out, whenever you have a crisis, the first response of every central banker is let's print money.
mhm,
It doesn't matter what the crisis is. It's a virus, it's a drone strike, it's whatever you want to call it. The first response of the central banker, let's print money, make everything okay. And that's definitely what they're going to do. So you remember, I think you were trading bonds back in March 2023. You remember that crazy move we got when Silicon Valley Bank blew up. So you had this wild short position across the curve in bond futures.
mhm,
They were just going down almost every single day. And then Silicon Valley Bank blew up. And I think bonds probably moved 5 to 7% in a day,
mhm.
which is, I mean, it's nothing in Bitcoin land, but
It's
it's the
insane in
equivalent of
bonds.
Bitcoin. Yeah, it's like equivalent of say Bitcoin moving 300% in a day or something.
Mhm,
So we had that crazy move. Everyone got wiped out. There wasn't even enough volume for people to get out if you weren't in the more liquid instrument. So it was a bloodbath. And if so, the not every so when you have a disaster that's pretty slow moving, which everyone sees coming, the impact isn't great because by the time it happens, everyone is already ready for it. Everyone has already priced it in. Whereas when you have something that happens rapidly, people aren't even, first of all, they're not even aware of what's happening. By the time they figure out what's happening, then they go get their committee meetings in place and then they go talk it out and then they come to a decision. Things have already moved. So here you have the situation where the yen started moving this week, and right now almost everyone says it's not a big deal. It's just back to the same level as it was a week ago. What's the big deal? Well, it's not just about the price movement. It's about how fast the price moved. It's about how what kind of impact this price move has had. And I think when you get into all that, you would start to see how this can affect markets. So if the whatever move happened this week, if some major player is caught in a bad spot, so you remember LTCM. So what happened with LTCM? The
Mhm.
brokers were in a bad spot and they went to the New York Fed and said, we need a bailout. And the New York Fed said, sure. So now, if someone's really caught on the wrong side of the yen trade and they go to the New York Fed or they go to the Treasury and they say, we need a bailout, is the Fed really going to say, no, inflation is too high and unemployment is increasing? That is, we are getting into stagnation, so I will not save you. I really don't see that as a possibility.
Mhm.
So I think they're just going to say, okay, here's some money. Let's paper it over for now. And whether it turns out to be temporary, like QE was temporary back in 2008, or the bank term funding program was temporary. So whether it's temporary or permanent is just different labels they give it, whether it's money printing, QE, whatever you name it. The first sign of the liquidities we got from the Fed opening up will send money back into bonds, especially because of where positioning is, and especially because the thing with rates is that they trend. So
Mhm.
the Fed, I think, probably once or twice in its history, it's had a path where they would cut and then hike and then cut. Otherwise, if you look at the Fed funds, it's always one straight path. Either they are cutting or they are easing. And of course, for the last 14 years, we had it at zero. But so when you have the first rate cut, it's going to trend. And if you're seeing labor market weakness and if you're seeing some major financial player in trouble, that's the perfect excuse for the Fed to cut because they can always say inflation is going to come down because once you cut rates, shelter inflation comes down, things like that. But the you said it perfectly, I think, in one of your articles where you said the Fed's mandate is to inflate or die.
Mhm.
And I think that point is going to come up pretty rapidly, especially if some player is caught on the wrong side of the yen trade. So buying bonds is just the most logical way to express the trade. And I don't know much about the other bonds, but treasuries seem to be the perfect. And of course, I'm sure you could buy the preferreds, you could buy the dividend plays because now we have companies which are yielding 4 5% dividends which have solid cash flow, but nobody cares because Fed funds is at. I mean, if you can get 5.5% with money in the bank, why would you bother with getting buying a dividend stock? So the whole 2018-19, there was this whole trade where people bought staples and utilities for the yield, and they bought bonds for the capital appreciation. So it was like a reverse way of looking at stocks and bonds. And now you have this entire situation where no one likes dividend paying stocks because well you could just have money in the bank and it earns more. So I think once the interest rates start to come down you could probably start buying these high quality dividend stocks. I'm sure there are many ways to express this trade. For me, it just seems like the easiest one is to just buy bonds, just buy the bond futures and figure out what comes next. So that's what I did.
Oh, nice. And I mean, I guess the other thing to also ask is, are you looking at this as a long-term trade, or are you looking for just a kind of a bounce, like you mentioned, the 5 to 10% bounce that happened at one point?
So the problem with the Fed cutting rates or rates going down in a stagflationary environment, and today's jobs report clearly shows that we are in a stagflationary environment wherein unemployment is going up, labor market is softening, inflation is high, which is the definition of stagflation. So if you have interest rates come down in an environment like this, so you have two factors at play. One is that the Fed will try its best to make long-term rates, that is the 20, 30-year rates, the interest rates to come down. They'll want to make sure that bond yields on the long end don't spike. But unless they do something like yield curve control or operation twist, they really can't do that. So the long-term rates will be in control of the bond market, and the bond market will be influenced by inflation expectations. And if the bond market sees the Fed cutting rates when inflation is increasing, I really don't know what's going to happen to the bond yields at that point. So it's an unknown factor. So we'll only know what's going to happen once it happens. So right now I see it as a trade, and that's also why I prefer being in the shorter duration bonds. So 2, 5, and 10. And I really wouldn't touch the 30-year bond. I think the 30-year bond is something that should just be avoided. It's similar to when in 2015 Argentina issued a 100-year bond. No matter what credit rating anyone assigns to Argentina, the prudent thing is to not touch those bonds, because Argentina probably has 10 currency crises in 100 years and probably two in a decade. So you have a situation like that. And the way the world is today, the way the treasury dynamics are playing out. So especially the recent sanctions on Russia, the way they just seized Russian assets and said, here we'll give it to Ukraine, and then Russia retaliating by saying, we are going to take funds, freeze JP Morgan's funds in our country to retaliate. And the way all this is playing out, you just don't know what's going to happen to the long bond yields, because this is not a stable macro environment, and you need a stable environment in order to buy those kind of bonds. So I think it was, goes back to history. So 71, 72, 73, sometime around that. So Britain used to have these perpetual bonds. They were called consols. And I think they just disappeared. And they had other securities called gilts. So something like 70 to 80% of the value of those bonds was just lost in those 2, 3 years. And then they also depreciated the currency, put in FX control. So you had a whole series of disasters happening to the United Kingdom, which is a developed country, and it all took place over a period of 1, 2 years. Now, if you are in the shorter duration bonds, of course, you will have a bid and you will be able to exit, because the way you and I see a macro picture, the way someone else sees the macro picture will be different. But if it's the 30-year bond, then I think everyone will pretty much be in unanimous agreement that this is just not going to work. So where the yield on the 30-year bond goes, or even the 20 to 30 range, I really have no clue. And I don't think that's something we can even guess until we see how the bond market moves. So my bet is just that when something bad happens, the central bankers respond like they always do, and they print money. And when they print money, short-term yields will go down. So the way to express that is to buy the bond futures, the near-term bond futures. So that was a simple reasoning behind just doing that trade.
No, that's why I asked it, because it's important to understand just for the context of how to put the trade together. I think as futures traders, it's great because we have the option to trade all these different products. It's very hard for a retail investor with trading ETFs to trade the bond market in an effective way. Sure, you can buy TLT, that's the 20 to 30-year bonds, that's on the long end. That ETF does have some alpha, especially if you use options. Those options are also very liquid. But if you look at the rest of the curve and you're looking at the short end and you're looking at things like SHI and SHIV and so on, you're not going to get any alpha out of that. And not to mention the options are completely illiquid. I don't know if that's changed over the years. I haven't looked at those options in 5 years, but I doubt they got very liquid over time. But look, also something to think about too. If you are looking at this chart of the bond market, I did have a question that asked about bonds, and why would you buy bonds? Why would you short bonds? They're all the way up here. I think something that was missed in this question was the fact that these are yields. So this is a chart of yields. So yields are inverse to bond prices. So as these yields, for example, if you're looking at this move from 2020 basically is when the 30-year bottomed and a lot of the bonds bottomed across the curve. And basically you had a huge move up in yields up until now. So if you're looking at that, that's basically saying bond prices, we were actually short bonds from 2020 till recently. They're still kind of on the short side, even if we look at it today. The trend is still the other direction. What Kashap is mentioning is that the yields he thinks are going to move the other way, and the short end of the curve, which is at the top right now, is going to start moving down. So he wants to buy the short end of the curve, 2-year bonds, euro dollar futures. They don't call them that anymore. I think they call them SOFR rates now. I'm never going to get used to that. But if we're looking at it that way, we also have to know if we look at the cycle and we go all the way back to, this chart goes back to 86. And if you look at the ones on the short end of the curve, the 2-year goes all the way back. The 1-year doesn't. So if we look at the 2-year, you'll see most of the time the 2-year leads the way. So if we are going to see a breakdown, what's logical and what Kashap is also mentioning is the fact that the short end is going to come down before the long end, which is completely right. That's usually how it works. Yes, sometimes there is some movement where one might lead the other one a little bit, but usually the way they top is that the short end of the curve starts to come down very quickly and hard. So, I mean, think of 2020 even, we get into the crisis. They're just cutting rates as fast as possible. You can see the green line way above the black line there. And then, as it bottoms, we see the 30-year, which is in 2020, the 30-year starts to lead the way up. And then all of a sudden, the 2-year starts to outpace that and catch up very quickly. So, the bond market is very dynamic, and there's bonds all over the world. There's JGBs, which is the Japanese bonds. There's a lot of people who've tried to bet one way or the other on those for many, many years. But being that the bond market is so dynamic, it's something also to always kind of pay attention to understand what the market's doing or what type of environment you're in. Like Kashap mentioned, that reflationary to stagflationary environment, which is what I also see we're moving into. We've gone from this reflationary where, some of those sectors like financials, energy, and so on did very well. And now we're kind of moving into more of a stagflationary environment. But that reflationary to stagflationary environment, you'll usually see yields moving up quickly in that environment. So when yields are moving the other direction, you usually see a different environment. So meaning that most of the time that's a Goldilocks style environment. When we saw bonds even bottom in October 2022 and the market bottom in October 2022, we saw the tech rally, and that's a Goldilocks style environment. Now we're in a very different type of environment. We have to continue to watch here because this is an incredibly dynamic market that I don't know if I've seen before. I've never seen the market in a inversion for this long. In the bond market, I've never seen the market kind of shrug off things the way it has over the last couple of years, which usually is telling me that there's something under the surface here, and that could be good or bad. Sometimes under the surface means that we have a reason to cut rates going forward, so the market's seeing that, which is why we saw this rally. Liquidity is also coming in many different ways, so maybe that could be some reason why the market rallies so much. Also, it could be another way, which is you could look at this and go, okay, well, these rates here are so high, and the amount of debt that we have in our economy, in our world, actually, not just the U.S. but the whole world, is putting so much pressure on everything that they have to cut rates at some point. Which is why, the statement I always leave, it's from Richard Russell, is inflate or die. Because really, people always, I had some conversation the other day and someone basically was very upset with what I said about that. And it's like, well, the Fed can do anything and they have all these tools and they do this and that. And I'm like, yeah, they have tons of tools and they can do a lot of things. But at the end of the day, they have that decision to make, and that decision is inflate or die. Can they hold rates at zero forever? No, because then they can't keep the game going. The game has to turn back into being able to cut rates again at some point. They finally do have the ammunition to do that at some point now. We have rates that we haven't seen since the early 2000s. And so we could see that turn down here. And that's what Kashap's looking at today. But I think it's a super interesting idea. You know, we're still, obviously, I'm a trend trader. The trends for bonds are still to the downside, but it's not, it makes a lot of sense here that we see a higher low in yields and then yields start to move back down, because that's what the market should be doing at some point. That's the normal reaction. Once again, you can't think of the market in a way where it should do this or it should do this, but you want to make your templates like we're talking about today. This is just a template. Here's the idea. This is what we think could happen. Use your risk management, your technical analysis, your fundamental analysis to get in and out of things, but also, you know, this is a roadmap, and I think it's a good roadmap to talk about. So are you trading the yen at all, Kashap, during this whole trading process?
No, so I got stock. I had a yen long a while ago, actually, before right after the previous FOMC meeting, and then it was just sitting there going nowhere for a very long time. And then you had a Bankspees breakout in the opposite direction. So you had a Bankspees breakout that said the yen is a short, and I was long. So I just waited it out a bit, hoping it's a false signal, and it wasn't. So somewhere around 151, I guess, is where I covered, and I haven't traded the yen since, because when you have when you have a central bank versus the entire market fighting it out, there is really no point in trying to trade that instrument. Like, what is the point? Nothing. Let them fight it out. Let them, bloody each other, and it doesn't really matter. So, what are the other trades that come up because of this scenario? So that's what I'm looking at, and what are the implications for not just bonds, not just stocks, but let's say what are the implications for everything else that I have in my portfolio? So that's the thing that I would want to focus on. So let's say I'm running at 200% long at that point, and I'm like, no, I have to cut leverage. So I bring down I cut down some of my long positions. I bring my leverage down because I don't know what's going to happen in the environment. So that's the way I look at it. I don't need to go see Apple's moving 8% after us. I need to chase it. Like, no, it doesn't matter. Like, yen is moving, I need to chase it. No, it doesn't matter. What are the things that I can focus on, and what are the things that I can focus on that could probably benefit from this move? So that's what I'm looking at. And right now, the only trades I've come up with for that is the bond trade and maybe the KRE trade. So I'm still not sure about the KRE, but I think if this plays out and we get lower yields, then they are going to be able to dig out of the hole they have in their balance sheet. So these regional banks have all these, they are just filled with treasuries on the balance sheet. And all those treasuries, they are now sitting on huge mark to market losses, unrealized losses. So the problem in the balance sheet is just going to keep getting worse and worse the longer the Fed waits to cut rates. But if we get a move and then the Fed cuts, then suddenly these banks aren't going to be treated as toxic waste. So that's just an idea. But again, with macro, you never know. So tomorrow you could have one more bank failing and that becomes news, and then carry goes straight down. But in that case, then what will happen is short-term bonds will get bid, because instead of having deposits in the bank, people are going to buy treasuries. So that's going to take money back out of the banking system and into treasuries, which is kind of what we saw with the whole reverse repo drain. So macro is just complicated. It's not something where you can say, it's not like when you go to your doctor and he's testing your reflexes. You hit your knee with a hammer and then your feet moves up. There's no 1:1 correlation like that. So just have to wait and see and just trade whatever the market brings, and that's what I'm trying to do.
No, that makes a lot of sense. When you, as a trader, I think too many people get too stuck in like, for example, we're having conversations about the yen, and they go, okay, well, the yen, that's cool. I don't really care. I don't trade the yen. It's the same thing. I had somebody write me the other day, and they were like, it's cool what you do, but I just don't trade commodities. And it's like if you don't understand the commodity, at least for me, sure, there's many other traders, and there's many ways to do this. However, if you're not understanding the commodity market, how are you understanding the other markets? Like the commodity market is, you can even figure out the markets that have nothing to do with commodities. But look at oil prices, look at oil prices and against semiconductors. Put that chart up, you can see when oil prices start to put a little bit too much pressure on that market. Same with airlines. You can see when oil prices are putting too much pressure on the airlines. Like, you can see all of those things by looking at the commodities market, and it's the same way with the currency markets. Understanding the yen, I mean, it's not a safe haven anymore. It used to be a little bit of a safe haven years ago and traded that way. It just hasn't in years. And if you go back and you look at the yen and you go, okay, well, the yen back in the day as a safe haven, the Swiss franc back in the day as a safe haven, you can kind of understand when markets are shifting. Very similar to if you're looking at the stock market and you're looking at the spider sectors, and you see utilities and consumer staples and REITs, all of these very safe haven, low risk areas are starting to lead the way on a 3-month or 1-month relative basis. Then you start to go, okay, well, maybe the market's in a risk on or risk off environment. The thing is, everything is connected in these markets, and it's something that you really have to take your time to understand and work on and learn. And as you continue to do that, you will understand why you'd want to be in all these different things, why you'd want to trade maybe something like the bond market when you're looking at the yen, because all of it's connected.
Yeah, so I think I became a much better trader after I started following futures. So, I mean, my background is I used to cover stocks exclusively. So I worked as an analyst doing fundamental research on commodities and mining stocks. And from there, I just evolved. And I think the final thing that really clicked for me was when I started looking at futures, when I started looking at how futures traded, especially around key moments like the Silicon Valley Bank crisis, or when you get a hot inflation report, or when the Fed started hiking. So when I started looking at how futures behaved in those scenarios, when I started looking at how wheat moved on the first news of the Russian invasion of Ukraine, so you start to see that, and that is really what gives you the full picture. Because if you're not looking at futures, if you're not looking at forex, you're really not understanding the market. The market is not. So every day, sometime in midday, you get this Bloomberg headline saying stocks rally on inflation hopes or whatever, or stocks rally fueled by Apple optimism, or some such nonsensical headline. And really, that stuff doesn't matter at all. So what really matters is liquidity. So you need to know what kind of environment you're in, whether it's reflationary, stagflationary, or Goldilocks, which is rare, or maybe a deflationary crash. You need to understand what's happening. So currencies are all in a race to the bottom. So you need to understand which currency is leading, which currency is lagging, and especially when you look at, like, I liked your trade idea where we looked at the pound versus the yen. So that's not a cross that's very common. So when you put those charts up, the world just starts to make more sense.
Yeah.
You have a situation where cocoa's going up like crazy, and it's driving the entire agriculture index higher. And then you have a correction in the index. Do you buy the correction? Of course you don't. Whereas, let's say you have a broad-based stagflationary rally where wheat, soybeans, corn, cocoa, coffee, sugar, everything is taking off, and you have a massive uptrend, and then you have a correction. Do you buy that correction? Maybe, because it's a correction in an uptrend. So when you have the when you have the full picture, it's a lot easier as a discretionary trader to make these calls. And I know for you the system is different because you have your signals, and your signals pretty much take care of all these data filters. And if you trade that way, you need to work on building that system. And if I trade the way I do, then I need to work on building this system. And it's not like there is just one way to trade or two ways to trade. Like there are multiple ways to trade, which all make money. But one thing that is common to everything is you need to look at the charts. Because
Yeah.
if you don't look at the charts, then you really can't trade. I mean, you can just say, I made $5,000, I saved $5,000 from my paycheck. I'm just going to put it in X
Hmm.
and, leave it for 10 years, see where it goes. But that's not trading. If you're a trader, then I think everything just starts with the chart, and it just makes sense that even if you don't trade commodities, even if you don't trade FX, you don't trade bonds, it doesn't matter. It's like I never traded bonds before. So I tried trading bonds once, and that was a disaster. That was right before the Silicon Valley Bank collapse. And I got free because one contract is $200,000 and it just moves a little bit. And you're like, holy shit, this is like
Yeah.
a big part of my account. And you're like, and if I'm having a bond position, there is no way I can buy something else because suddenly all my margin is used up. And so I never traded bonds before. This was my first time. But I have been following the market for a long time, and I've been following all the, especially the work you do with the intermarket analysis, where I mean the copper to gold ratio, or whether you're looking at bonds and the S&P, whether you're looking at advanced decline line, all these charts really tell you the whole story. And if you're not doing that, then I don't think you can really be a good trader without doing that. Or if you're already a good trader without doing that, I think if you just add that, it just multiplies wherever you are. Because that was my experience. I think it was around 2022 that I started following all the other markets, and that really has enriched my trading style. So yeah, that's my 2 cents.
No, I completely agree. I think that's it's the key the key to trading. I mean, I even like the way you mentioned that basket idea with DBA or DB. Yeah, it's DBA. With DBA, the commodity ETF or the agricultural commodity ETF. You know that all that stuff is incredibly important, and you have to figure out a way to quantify things like that, or basically have it on your list that you go through every day. Quantifying things like I do or systematizing things is more the fact that it comes through in a data point and I have it all wrapped in a bow by the time it gets to me. That's the only difference. But the rest of it is just it goes through the same exact process. It's just not me doing the process. It's me who built the process, but now I figured out a way to build the process so I'm not sitting there having to do that every minute. But also like looking, there's nothing more powerful than just really looking at those charts in that way and finding that analysis, and sitting there and kind of digging through and looking at it and understanding what direction things are moving, where they're moving to, and how you're going to trade that. I think that's all super important. I hope everybody grabbed that piece out of it because it's important to understand when you have a basket of whatever. Everything. I mean, the one thing that I agree and disagree a little bit with in Reminiscence of a Stock Operator, but it's the first thing I ever learned that made a lot of sense to me and helped me as a trader, which is in a bull market, all stocks go up. In a bear market, all stocks go down. And for the most part, 99% of that is true. So, and more importantly is, even if it's that true, you should still use it. Like nothing's 100%. It just says that most of the time, when you're in that bear market environment, nothing is going to go up. Look at energy, in 2022. Yeah, energy did well, but that was it. It was the only thing that did well. Nothing else did. And it wasn't like some crazy out, but after the Q1, it wasn't some crazy outperformer. It just was chilling, going sideways the rest of the time. So you really have to understand these dynamics in the macro environment to trade. for example, if you're a stock trader and you don't understand that the market's in a bull market, and let's say oil is raging too, then you don't really know where to be positioned. Let's say oil looks like crap, and something like today, where we're seeing gold showing relative strength to a lot of things, and you're also seeing the stock market's very volatile, and then you could figure out maybe a different trade in that. Kashop's figuring out through this environment that he would want to be in the bond market possibly. I think all of that is how you trade and trade well. So I actually have to go in a second. I got another video in a minute with a client. So Kashop, awesome to talk with you, man. Let's do this next week, and I'll see you soon.
Absolutely. Thanks, Jason. This has
Thank
been
you.
my pleasure.